Hello everyone. Share market is a world of thrilling highs, nail-biting lows, and constant surprises. Beyond the company fundamentals, the quarterly results, and the market trends, there is another powerful force silently at play, influencing every single decisions we make. That force is bias. We often like to believe we are rational investors making decisions purely based on data and logic. However, the truth is, our brains are wired with certain shortcuts that can subtly yet significantly skew our judgment. From the seasoned traders to the budding investors, these biases affect everyone. In this video, we will explain some of the most common biases that creep into the minds of Indian investors and discuss the strategies to overcome these biases. So, the biases in Indian investors can be broadly categorized as cognitive biases and emotional biases. Let's see them in detail. The cognitive biases stem from how individuals perceive, process, and interpret information, often leading to systematic errors in judgment and decision making. Now, there can be several types of cognitive biases. Let's understand some major with the help of few examples. So, the most common cognitive bias is the overconfidence bias. Now, it is a tendency to overestimate one's own abilities, knowledge, and the accuracy of one's judgments, leading to excessive risk taking and trading. For example, a new retail investor, after a couple of successful trades in a bull market, for example, during the post COVID rally in sectors like IT, healthcare, etc., believes they have a specific knack for picking stocks. They might then significantly increase their position size or engage in speculative futures and options trading without adequate knowledge, often leading to substantial losses when the market turns. Okay, let's move on to the next type of bias, which is the anchoring bias. Now, this bias is about relying too heavily on the first piece of information encountered when making decisions, even if it is no longer relevant or accurate. For example, an investor bought a stock, say, of company XYZ Limited at rupees 500. Even if the company's fundamentals have deteriorated significantly and the stock is now trading at 200 rupees, they might anchor to the 500 rupees price and refuse to sell, hoping it will return to that level, ignoring the current weak outlook and market conditions. Moving on, next is the recency bias. This bias is about making judgments based on readily available information or the recent vivid events, often overemphasizing their importance and neglecting broader data. For example, after a major news channel extensively covers a few multi-bagger stocks that have performed exceptionally well in the last 6 months, for example, small cap textile companies suddenly surging due to government policy, investors rush to buy similar stocks or even the same ones, ignoring the long term track record or actual fundamentals. Let's move on to the next bias, which is the confirmation bias. Now, this bias is about actively seeking out, interpreting, and remembering information that confirm one's existing beliefs or hypotheses while ignoring or downplaying information that contradicts them. For example, an investor believes a specific PSU bank stock is undervalued. They will actively read articles and analysts' reports that supports this view, while dismissing any negative news or warnings about its asset quality or competition as a temporary or irrelevant. Let's move on to the next bias, which is the representativeness bias. This is about making judgments based on stereotypes or limited observations, assuming that a small sample or a specific characteristics represents a broader trend or population. For example, an investor sees that several pharmaceutical companies have performed well recently due to a new drug launch or export opportunity. They then assume that all pharmaceutical companies are good investment and blindly invest in any pharma stock without evaluating individual company specifics. Okay, let's move on to the next one, which is the conservatism bias. Now, this bias is about being slow to update one's belief or forecasts, clinging to prior views even when new and relevant information emerges that should prompt a revision. For example, Indian households have historically preferred traditional savings instruments like fixed deposits or gold due to perceived safety. Now, despite consistent long term outperformance of equity markets and growing financial literacy, many still allocate a disproportionately large amount of their savings to FDs, slowly adjusting to the changing investment landscape. Okay, so these are the major cognitive biases. Now, there are few other cognitive biases as well. For example, illusion of control, hindsight bias, framing effect, self attribution bias, and ambiguity aversion. Let us now move on to the next type of biases, which are the emotional biases. Now, the emotional biases arise from psychological feelings, impulses, and attitudes, often leading to irrational decisions that are not based on logical analysis. Now, there are several types of emotional biases which can be seen in investors. Let's explore few of the major ones. So, the first and the most common type of emotional bias is the loss aversion, which is also known as the disposition effect. This is the psychological tendency to feel the pain of losses more intensely than the pleasure of equivalent gains. This leads to holding on to losing investments too long and selling winning investments too quickly. For example, an investor holds on to a stock that has fallen 30% from their purchase price, for example, from 100 rupees to 70 rupees, because they do not want to book a loss, hoping it will recover to 100 rupees. Simultaneously, they might sell another stock after a mere 10% gain, for example, from 100 rupees to 110 rupees, to lock in profits, missing out on further potential upside. Let's move on to the next one, which is the herd mentality. Now, this is the inclination to follow the actions of a larger group of investors rather than relying on one's own independent analysis or judgment. For example, during a meme stock craze, like some recent example on social media platforms, many retail investors pile into a particular stock simply because everyone else is buying it, without understanding its fundamentals or long term viability, leading to bubbles and subsequent crashes when the sentiment shifts. Moving on to the next one, which is the familiarity bias. This bias is about a strong preference for investing in assets or companies that one is familiar with. For example, local, known brands, one's own industry, etc., even if better opportunities exist elsewhere or even in international. For example, an investor who has worked in the banking sector for years might heavily invest only in the banking stocks, or an investor might only buy stocks of companies whose products they use daily, neglecting other potentially lucrative sectors or diversified options. Moving on to the next one, which is the mental accounting bias. This is the tendency to categorize and treat money differently based on its source or intended use, leading to inconsistent risk taking behaviors. For example, an investor treats their salary savings very conservatively, putting them in FDs. However, they might treat profits earned from a few successful stock trades as free money or bonus money and use it to take highly speculative bets in F&O market, justifying the higher risk because it is not my main capital. Okay, let's move on to the next one, which is the regret aversion. Now, this is the desire to avoid the pain of regret, which can lead to inaction or making decisions that minimize the possibility of future regret, even if those decisions are not optimal. For example, an investor might avoid investing in the stock market altogether after experiencing a significant loss in the past, for example, the recent corrections, fearing the regret of another potential loss, thus missing out on long term wealth creation. Or they might not sell a poor performing stock to avoid regretting selling it if it later rebounds, even if it is unlikely. Okay, so these are the major kind of emotional biases. There are few others as well. So let's see the other emotional biases: optimism bias, greed bias, sunk cost fallacy, endowment effect, status quo bias, and the story bias. Also, what is the narrative fallacy? So these are all kind of emotional biases. Now, how to overcome biases, how to overcome the cognitive biases, how to overcome the emotional biases, how to overcome biases in general. Overcoming biases in the share market is crucial for making rational and profitable investment decisions. It is not about eliminating emotions entirely, but rather about recognizing their influence and implementing strategies to mitigate their negative impact. There are 5 strategies to overcome biases in the share market. First is the self awareness and education. Understand what common biases are and keep a journal of your investment decisions. This helps you recognize your own emotional patterns and learn from them. Next is develop a robust investment plan. Create a clear return plan that outlines your financial goals, risk tolerance, and how you will allocate your assets. This acts as a roadmap to prevent impulsive decisions driven by market noise. Next is the implement disciplined strategies. Use approaches like systematic investment plans to invest fixed amount regularly, regardless of market conditions. Automating investments removes emotions from the process. Next is seek external perspective and information. Always do thorough research and actively look for viewpoints that challenge your initial thoughts. Consulting a financial advisor can also provide objective guidance. And fifth is the cultivate mental resilience. Focus on your long term financial goals and remember that market volatility is normal. Practicing mindfulness can help you stay calm and avoid knee jerk reactions driven by fear or greed. So, as we wrap up, remember this: the share market is not just about numbers, it is about human behavior. By understanding and consciously working to overcome these biases, you are not just becoming a smarter investor, you are becoming a more disciplined and resilient one too. Keep learning, keep growing, and may your investment journey be a truly rational one. That is all from my side in this video. Thanks for watching it. Please like, share, and subscribe. I'll be back soon with another video. Till then, goodbye.